Tariff inflation is here. That's the message we get that gets the dollar going and, at least temporarily, spooks the stock market today. Will consumers get discouraged? That's what we're going to try to unpack here because, as ever, that is the biggest question for this U.S. economy and ultimately then the markets. I'm Ilya Spivak, head of global macro here at tastylive. This is Macro Money. And we're going to take a look at what the markets did with today's data offering, potent though it was, and consider what all of this means as we start to look at what consumers might do with this and why that's so important when we get retail sales and consumer confidence numbers here in less than 24 hours. So let's break this down. The market today, a little bit soggy, but only a little. S&P 500 down 0.07%. NASDAQ down a little bit more, 0.28%. Hardly major changes here after yesterday's big moves and, frankly, big moves earlier in the week. That CPI report we got this week still largely intact for its influence to the upside on these markets. Probably the biggest swing, which we don't have on the chart here, was the Russell down 1.28%. That's after a rally of almost 2%, 1.96 yesterday, and a blistering almost 3% rally on that US CPI report the day before. So we have a little bit of a cooling off rather than some sort of a capitulation in stock markets today. Notably, yields go up. 10-year up 1.25%, 2-year up 1.44%. Crude oil is up for its own reasons again, it would seem. It's really been moving around a familiar range here for its own reasons. We, of course, have that summit between U.S. President Trump and Russian President Vladimir Putin in Alaska coming up, so maybe that's something to do with that. But oil has been really pinned to this central axis around 62.20, 63.40. That's been a sort of center line for the broader 54, let's say, to 73 range, going all the way back to September of last year. So yes, we get a little bit of a pop, but do we ultimately get anywhere from that center axis? Not really. In line with the move in yields, in line with the move in stocks. Gold down a little bit here, 0.8% almost. Euro down, yen down. That, of course, speaks to a stronger US dollar. And Bitcoin off 4.09%. Again, not the craziest change in sentiment here for Bitcoin. I mean, certainly it's a notable thing that it has swung as it has, and indeed it's erased 3 days of gains today. It's essentially back to where we were last Friday, but nevertheless, we're still sort of in this broader 123,600 to 113,000, let's say, range that's persisted since mid-July. So notable swing, certainly, but again, not anything that appears game-changing per se. But certainly the tone here was weaker risk, higher yields, stronger dollar. And that sort of comports with what we're seeing in Fed policy odds. Note here, we're still very much on track for a September rate cut, 92.8% probability in Fed funds futures. But whereas yesterday there was about a 6-7% chance that it'd be a 50 basis point cut, not 25, today it's a 7% chance that there is no cut. So we're getting fuzz at the margins here, and whereas yesterday the fuzz was in favor of a more dovish perspective, today the fuzz is in favor of a slightly less dovish perspective, but the central thesis remains September is probably going to be a rate cut. But the markets clearly saw some data today that swung them from erring dovish to erring less dovish. The outlook on the path forward here overall, now firmly 50 basis points for this year. That's exactly in line with the Fed's own forecasting from the June summary of economic projections. That's the last time this was updated. 50 basis points here from 4.4 to 3.9. But then the disparity continues for next year. The Fed sees only 25 basis points here. The markets are discounting clearly a lot more. They're fully priced here, it would seem, for 3 cuts next year, give or take a few basis points. So the architecture of what happened here yesterday into today is broadly holding. But the markets clearly caught a little bit of indigestion, and they caught it because wholesale inflation numbers, incidentally, as we suspected earlier in the week, and as we talked about the CPI report, suggested that that CPI report in its benign visage is smoke and mirrors to a significant extent. And that, of course, came from PPI data. So here we have it. This is the month-on-month increase in wholesale inflation. We can see with the naked eye here that this is a dramatic month-on-month surge in wholesale inflation, 0.9%. By the way, it's the same number for headline and core. So this is exactly the kind of wholesale inflation that you cannot write off by saying, well, food prices, energy prices, the Fed doesn't care about those. That's something that they don't have agency over. This is not going to make or break policy. No, this is core as much as it is headline. This is an eye-catching jump by any stretch. And we can see here that the reference point for this goes back, obviously, significantly to this reflationary surge that we saw through COVID. This is ultimately what the Fed moves to act on with those rate hikes in 2022. So here is the middle of 2021 where the Fed kind of starts to recognize they have to make a move. And of course, this is where the hiking cycle kicks off. So we're back to essentially a 3-year high here for the last time we've seen comparable jumps. Here's the year-on-year reading. At this point, we're back to February for overall wholesale inflation, but the violence of the jump is clearly on display here. If this was something like what looked normal through the markets digesting the onset of tariffs, well, we're not digesting them anymore. They're starting to appear, and they're starting to show up in wholesale inflation. Most importantly, I would argue, if we look at how this has worked up to this point, we've seen that wholesalers have eaten extra tariff costs by basically saying, we're just going to make less money. We're just going to take it in margins. And we're going to accept lower margins on our business because what we're going to do is we're going to eat these tariff costs. And the reason why we're going to eat them is we don't know what's going on with this tariff regime. Things are changing very quickly. We're not going to pass on higher costs to consumers, get those consumers to stop buying stuff, and then the landscape changes and it turns out we've destroyed our own demand for no good reason. So since the beginning of the year here, we can see even at the final demand stage of wholesale inflation, this trade services component, that's wholesalers' margins. And we can see here that in this latest data, those margins shoot up aggressively. Back to January 2022 is where we have to go to see something comparable. And of course, what that means is rather than eating inflation and letting it bring down margins, it is being passed on and those margins are expanding. So wholesalers are passing on tariff inflation. Most importantly, where this holdover, this insulating of consumers was most pronounced was even earlier in the supply chain. We can see here this is final demand for PPI. This is PPI intermediate demand. So this is the very, very beginning of the supply chain. This is where the tariff cost is initially felt. And we saw back in April when we sort of hit maximum holy moly on concerns about tariffs, they end up taking a hit of over 2% in a given month on margins, which is a huge hit, a recession-like hit, where wholesalers say, we are not going to pass on these costs. Well, they've started to pass them on. We get this jump here in excess of 1%, even at the intermediate level. And this ends up being the biggest jump at this stage of the supply chain since the middle of 2023. So we're talking a 2-year comparative reference point. Now, obviously, there's fuzz here as we get initial kind of fuzz around the tariff implementation. But if we kind of take ourselves outside of 2025 and consider what is a reference point for this historically, this is where we're looking. Now, when you get this kind of a thing, when you get wholesalers eating the inflation at the start of the supply chain, what you end up with is the kind of CPI numbers that we've just seen, where most inflation is still in services. This is where the markets go, oh, well, this is so refreshingly normal, 2.7%. Okay, so we get a little bit of a bump, but this is not anything crazy. And in any case, the goods side of the inflation story is still relatively modest, even though it's perking up. Or so it would seem, because again, most of inflation is still living in services. But what we see from the thrust of the change here, where inflation is dynamically moving higher versus not, in services, it actually comes down in terms of its contribution in July, but in goods, it's clearly going up, so much so that we can see here the thrust in goods for a second consecutive month is almost a tenth of a percentage point, whereas in services, it's actually going the other way. And as we saw earlier in the week when we unpacked this a little bit, core goods inflation went up month on month in July. Core services inflation went down. The rate of core goods inflation is the highest in 2 years at this point. This is our reference point back here, sort of mid 2023. Services inflation is also going up, but much more so within its range. The reference point here, December of last year. So what we're looking at is indeed evidence that suggests that we have tariff inflation now heading in the direction of consumers. And of course, where this becomes particularly worrying is when we look at these GDP numbers for the second quarter, what we see is, on the one hand, the other force keeping inflation at bay for consumers. We can see in the first quarter here a giant front run of imports. And again, this is contribution to GDP, and imports are subtracted from GDP. The component from the external sector in GDP is exports minus imports. And so the surge in imports here looks like a decline because this is a detraction from GDP that imports are surging. We can then see in the second quarter, imports are an addition to GDP because they're cratering. By the same logic, we can see here in the first quarter, inventories, which are a part of the investment component here, they surge because obviously all these imports have to go somewhere, and they're not going to feed current consumption. They're going to stack warehouses full of goods at pre-tariff costs. We can see that in the second quarter, those inventories are falling. That is, those goods are being spent. They're being sold out of inventory. So rather than companies buying goods that are now including of tariff costs, they are being sold out of inventory. But of course, imports have cratered, so those inventories are not being refilled. So not only are wholesalers now passing on inflation costs, as the PPI data here suggests, but we are now seeing the other source of defense for consumers, this inventory buildup in the first quarter, that's falling away because those inventories aren't being rebuilt and the stock that's in them at the lower cost is being depleted. All of this, of course, comes together to tell us a story about how consumers are going to start to really feel these tariff costs. And what we already have in this GDP data, as we've said time and again here, is the contribution to GDP from consumption, which is by far its largest component, 68% of GDP. This contribution is already the smallest in the first 6 months of this year since the first 6 months of 2020. That, of course, is the COVID recession quarters. So consumption is already weak, and now we have this pass-through of inflation to consumers, not only because this front run is running out of room, but also because clearly wholesalers have started to make their move. You can see that here. This, of course, makes for very interesting watching as we get retail sales numbers coming out here to finish the week in macro event risk, 0.5% rise expected month on month after a 0.6% rise in the prior month. We're also going to get consumer confidence numbers. The expectation is that we're going to hold relatively steady on the current conditions index. Maybe we'll even get a little bit of a slide up on the sentiment side of things, but expectations expected to dip. And of course, not only are we going to be watching very closely what happens with the interplay between these numbers, but also with the one-year inflation forecast, which we can see here has been a critical driver of consumer sentiment. Indeed, since we saw the peak in inflation concerns going into the Fed's rate hike cycle, this is when they finally say, you know what, it's time for us to get a move on. This peaks as sentiment bottoms because, of course, the Fed starts doing the hikes that they so aggressively delivered in 75 basis point increments. And so inflation expectations start falling, consumer sentiment improves. Then we get to the tariffs. Sentiment craters as consumers start to say, well, the tariffs are going to be very inflationary. So we get this jump in one-year inflation expectations from 2.6 to 6.6 at its worst. But we've now cooled back down to 4.5 as of June's numbers. We'll see if we get further cooling here into the August numbers. But if in fact consumption is already weak as of the end of June, the second quarter GDP numbers, And we can see that in July, costs are already starting to feed from wholesale inflation and into headline. Then the expectation would be, perhaps amongst consumers, that inflation is actually going to be higher going forward, not lower. And if this starts to tick back up, well, then that's bad news for sentiment. So the threat here facing markets is that, in fact, what we are on course for is another weak consumption quarter in the third quarter. And this is the ingredients from which recessions are made, because, of course, we have an economy that's overwhelmingly consumption. Now, from the perspective of the markets do not want to see recession-flavored data. In fact, we saw that in spades with the jobs report, that's this wiggle lower here, which was, of course, very disappointing. And we see this rebound because what that ultimately gives us is a more dovish outlook on the Fed. But as these numbers go, if we get very strong numbers, well, then the outlook on the Fed can't get very much more dovish. If we get numbers that are relatively close to expectations, then chances are the probability of a September cut remains broadly intact. If we get very weak numbers, like we did with the jobs report, ostensibly the markets become more concerned with growth than they are with rate cuts, as the jobs report pointedly showed us. And then stocks don't like that either. So the middling outcome, the middle of the distribution outcome for both retail sales and sentiment is ostensibly what the markets are after here. But perhaps even more interesting than stocks is the US dollar, which has been carving out a bottom. At the very least, it has stopped falling after this precipitous decline in the first 6 months of the year, even as you get this most recent dovish shift in expectations. And so whatever happens tomorrow, perhaps one of the more interesting trades on the board is either you get a safe haven dollar that rallies because the markets don't like retail sales numbers, or the retail sales numbers are strong. Stocks are left scratching their head as to whether they like the earnings part or the less dovish implications for the Fed. But with those less dovish implications, you get a stronger dollar, much as you saw today. So if stocks are perhaps a little bit fuzzy, the US dollar, in its resilience since the beginning of July, seems to be telling a story. We'll see what that story means for stocks, but for the dollar, it might mean an interesting trend change opportunity that is just beginning to ripen. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour Mondays and Fridays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Happy trading.